Modern portfolio theory tells us that diversification offers the only free lunch in finance. In reality, what we find when we work with a number of our clients on their equity portfolios is what they often end up with is an expensive index fund. I'd like to share with you some of the key elements of the paper that we published in the Financial Analysts Journal on over-diversification, which includes the implications for active risk, active share, and factor risk in portfolios, how diversification impacts your ability to generate alpha, and what it means for fees. Now, our research has been done out of the US, and bear with me for a little bit because I will try to bring this into the Australian context. But here, what I wanted to show you is some information on pension funds, US pension funds, and ultimately, how many funds they employ. We took this data from pension and investments, we distilled it down so that we were looking at the defined benefit plans and focused on equities only, public equities. And you can see that we had 88 funds that we looked at, and of the 88 pension funds, you can see on average they employed 17 fund managers. You can see that as we became larger, they employed more fund managers. But what was really interesting to me here is the fact that even if you look at the 1 to 10 billion bucket, you still actually have quite a number of funds. So this suggests that it's not necessarily just scale that's driving fund managers to employ active managers in their portfolios, that it could be the fact that they're focused on trying to diversify. Now, we've got another polling question. Hopefully they can put it up. This is where we bring it into the Australian context. Okay. The question is, what do you think the average number of managers of the Australian super funds employ across their global equity portfolios? So 0 to 5, 5 to 10, 10 to 20, or 20 plus. So if you can take a few minutes, let's see. Okay, almost in, everybody. Okay. Ooh. All right. Almost there. It looks like it's quite interesting. We're duking it out between 10 to 20 and 5 to 10. So I think let's see, maybe 10 on average would be the guess based on that. I have a little bit of data actually for you. We did a little bit of work and we looked at about 62 of the major funds in Australia. We focused only on international equities, so this does not include Australian equities. And we found that the average was actually 8. So you're not too far off actually. Now the highest number employed was 19, so certainly a lot less than what you've seen in the US where the largest number was 67. Over 12% of the funds had greater than 15 managers, 25% had 4 or less managers, and actually 7 funds only had 1 manager. So that's actually quite interesting. Either the size here is smaller or maybe you guys are smarter. Now let's jump into some of the analysis. It can get quite technical. I'm going to try to make it de-technical it, but here what we've done is we wanted to take a look at the active risk opportunity set for combined portfolios. So effectively what happens to your active risk as you add portfolio managers. Now, just to give you a little bit of background, we took 663 strategies, equity strategies from Morningstar. The focus was large cap blended, large cap value, and large cap growth. Each of the funds had to have at least 50 holdings. And so what you're seeing in the dark blue is I guess the average or the combination of all those 663 portfolios. And you can see that the average risk here ends up to be somewhere on the order of 3.3%. Now, what we did in terms of combining these portfolios for 4 or 10 groups, we did a Monte Carlo simulation. We did 10,000 per simulation. And what's interesting to see is that as you added managers to your portfolios, you started to see the active risk falling. So the average active risk fell from 3.3% to 1.2%, which looks a lot like an enhanced indexed. Now here, let's talk about active stock-specific risk. So you pay your managers to make stock bets, generate alpha. That's what you're paying them fees for. But what's interesting is that not only does your active risk fall when you start adding managers, your stock-specific risk or your stock risk actually falls as well. In this case, what we did is we actually, out of those 663 portfolios, we selected 10 with the highest active risk, highest active share, and the highest percentage of active risk attributable to active share. So you can see the first one, the proportion of active risk attributable to active share was around 87%. And as we added the second, the third, the fourth, you can see that we actually fell all the way down to 40%. So despite the fact that you are paying your managers to take that stock-specific risk, as you start combining the portfolios, you find that that actually starts to fall, and what you get instead is factor risk. Now, I wanted to kind of give you a little bit of context. This can be a little bit dry, so I want to give you an example of some of the work that we're doing with a client in Asia. This client has 32 portfolio managers, and when we combined all the data of their portfolios, we found that the active risk was 275 basis points. And you think, that's not too bad. That's a little bit surprising. Well, what we actually found was factor risk was actually 93%. So while they were paying a bunch of fees to their 32 managers, they really weren't getting stock-specific risk, they were getting factor risk. What do I mean by factor risk? Well, the usual factors like style and momentum, but this also includes things like industry and country. Now, in this case, they had a significant exposure to country risk. And so they were actually taking active views on country, and that was how they ended up with all of these managers by saying, oh, well, I really like Japan, so let's add a few more managers in Japan, and taking some country views by, hiring more managers. What they ended up with, however, is being underweight 28% to the US. So I can imagine what the portfolio performance looked like relative to their benchmark. But the point here is that it's very challenging to maintain a high stock-specific risk. So you can target some of the factor risk here. And unlike our Asian client, you can probably do it in a much more cost-effective way. Now let's turn to the relationship between returns and active risk. As we know, active risk falls in your portfolio as you add managers. What we've done here is use the fundamental law of active management by Grindhold and Hahn. I won't go into all the details of the ratio, I'll let you read it, but effectively what we wanted to do is look at what happens to the potential for returns as your tracking error falls or as your active risk falls. So what we've done in this slide on the second-hand side of the chart is focused on maintaining an excess return of about 1%. And we held breadth steady in different groupings. Breadth is very hard to calculate in portfolios, so what we did is made a few assumptions and held them steady. And so as we saw the active risk falling, what you've seen is your information coefficient rising, and it's rising exponentially. So what that means is, your information needs to increase to hit your return target as the number of managers increases, which requires an exponential increase in your manager's forecast accuracy, which frankly is a lot to ask of your managers. Now let's turn to fees, because everybody cares about fees. What we did is, again, we took those 663 portfolios, and that's kind of the blue chart, the blue dots. And you can see that we looked at the active share relative to fee. So you can see it's upward sloping, meaning that, you're willing to pay more fees for more active share or more active risk. What we did then was that 10,000 simulation combinations for 10 portfolios. That's kind of the light blue dots there. And what you can see is that it shifts to the left and upward. So effectively, what diversification makes you pay more for risk. Now, here's where things get a little technical. I'm not going to go through all of these formulas. You can go and get it yourself. But what I wanted to do was leave you with a simple way to think about if I add portfolio managers, what happens to my active risk, and then be able to look at the fees per active risk and the implications as you're adding managers. Now, these simple rules have a few assumptions. 3 assumptions. 1, that all of your active managers have the same risk. 2, that they're all equal weighted. And 3, that there's no correlation between your managers. So they are assumptions that are probably not likely to hold, but they are assumptions that make it create a simplified rule for you to be able to utilize and figure out how many managers will affect your portfolios from a risk and from a fee standpoint. Now, for example, if you wanted to target a 25 basis point per unit of active risk, and you had each manager with a 4% active risk charging you 50 basis points, then you can easily calculate that means you should be hiring around 4 managers. But going to the first, I guess up to the top, to the first formula, that's the word I was looking for, you can see that in that case, your total risk falls to 2%. So meaning that 4% active risk that your manager has, dividing that by the square root of 4 managers gives you a total risk of 2% for a fee base of around 50 basis points. Now here I'm just showing you, does that rule work? We made a lot of assumptions. Can you really utilize it? So what we did here is we did the predicted fee active risk ratio, and then we did, again, those 10,000 simulations to show what would happen in actuality based on that information. And you can see that it's not too bad. We slightly overestimate the fees per active risk, and this is most likely due to the fact that your portfolio managers are likely not 0% correlated. There's probably some level of correlation, but generally speaking, it still holds true as a pretty decent rule of thumb. Now, just wanted to very quickly talk about how we work with some clients on redesigning their equity portfolios, some of the things that we think about. So you can see the traditional is, let's do a core cap weighted with a bunch of satellites, probably too many satellites, and how do we redesign it, or how do we think about it? Obviously the real focus is on getting the right combination of fees and active risk and returns in your portfolio. So some of the things that you might consider would be putting things like an enhanced style product into the core, which gives you a low tracking error, but potentially gives you a little bit of alpha generation. What goes into the satellite, though, it's not a one-size-fits-all, obviously. There are scalability issues. There's different views on active versus passive, quantitative versus fundamental. You can incorporate all of those into redesigning the portfolio. And obviously, because factor risk is something that you have in your portfolios, you can actually focus on particular factors that you may have beliefs in, or just generally look at a smart betas type product. So what's the solution to the problem? Well, easy. Number one, reduce the active managers. Easy to say, hard to do if you've got scalability issues. But you should be spending more time on strategic asset allocation and less time on analyzing active managers. What you want is somebody who can help think through some of the strategic top-line views of how do I want to redesign my portfolio? Am I getting surprises like an underweight 28% to the US from all of the groups of fund managers that I have, and how do I want to think about redefining it? Developing a close relationship with the retained active managers that you have can help. People like ourselves, you've got consultants, there's a number of people that can do that, but the point is you probably should have somebody help you with that. And finally, the diversified equity program is likely to lead to high factor risk, so why not target it with purpose? You can, there's a more fee-efficient way to think about getting exposure to factors. And with that, I will turn it over to Chris.
Hello, thank you. So this is the last session of the day, and I'm holding you up, but I'm going to talk to you today about equity portfolio construction, and we're going to approach it from an after-tax perspective. So maybe I'm preaching to the converted. The polling question at the start threw me a bit, so I thought more people would be focusing on pre-tax returns, but it seems like I've already won you over, but we'll see how we go. So the research is actually based on a paper that's been co-authored between myself, Raewyn, and one of Raewyn's colleagues in Seattle. The title there, Optimality, is in the eye of the beholder. It's a great read for the insomniacs. So if you would like to hear more from today's presentation, the link is on the slides, which I think you have access to. So you can download that later. So what we know is superannuation funds hold around 50% of their portfolios in equities. And so with such a high allocation, obviously research comes along with that. And we've identified a lot of research areas, active versus passive, regional allocations, whether you want to be Australia versus developed versus emerging, risk and style factors, how you combine those style factors, managing trading costs, and impact of taxes on your returns. And I should probably add to that over-diversification as well, which is a new field of research that we've seen today. What we found, though, was very little research exists on how you combine all of those factors into a single decision framework to assist with portfolio construction. We approached it from the perspective of a hypothetical superannuation fund, which I'll add is not the fund that I work for, it is purely hypothetical. And so we wanted to give it a real-life, practical perspective over the type of constraints that a super fund will go through. So our particular fund has a set of beliefs. We will consider both active and passive management and believe that they can make sense either in isolation or in combination. We believe in active management to an extent and believe that we can pick moderately skilled active managers. We're defining risk here as tracking error, and we've set a limit of 2% on the total portfolio. like all funds, we are fee conscious, and we've set a 50 basis point cap on the portfolio. We control turnover, which is good discipline, good for RG97. And we prefer mandates over trusts, and we consider after-tax outcomes in the in the outcome. And how do we define optimal? Kind of what are we looking to do? We realise optimal can mean different things to different people, and it depends on your objective and what you're trying to achieve. So at the beginning, we had 3 questions. Is it to create the portfolio with the greatest pre-tax alpha, the greatest post-tax alpha, or the greatest risk-adjusted return, which could be a Sharpe ratio or an information ratio? Maybe this third point doesn't make sense anymore. Most super funds would focus on pre-tax returns. I'd still question the extent to which you're managing your post-tax outcomes. But yeah, so we're seeking in this research for a hypothetical fund to maximise its post-tax returns in a reliable and consistent way. To help achieve that, we are going down the core and satellite route. Michele's just done a great job of explaining core and satellite, so I won't spend too much time on it. And thank you to Aist here for the colour scheme. I think it gives a new flavour to a colourful active manager. But we've split our core and satellite. It's purely illustrative here. For those of you who aren't familiar with the core satellite structure, your core portfolio is generally a rules-based, passive-like type portfolio. The satellite can be made up of a mix of different active strategies across styles, across regions, small caps, whatever you want to do. So this is purely for illustration. Going into our core portfolio, our particular fund's core portfolio it's passive-like, but we're looking to enhance some tax, to generate some tax efficiencies within the fund and generate some post-tax alpha. So you can see here what the core portfolio is doing. I've got the pre-tax and the post-tax returns there. So the portfolio return on a pre-tax basis is index-like. You can see excess returns of minus 9 basis points. When you factor in fees of 10 basis points, that's the index. What we're doing, however, is using a small bit of tracking error, 68 basis points in this instance, and a moderate amount of turnover of around 8%. To generate some tax efficiencies. So if you look at the right-hand column, you can see we've gone from a pre-tax underperformance to a post-tax outperformance. We won't go into details of how we do that. We can maybe cover that in some questions later, but this is the framework that we're using. And so you can see the post-tax alpha there is about 22 basis points. Our satellite portfolio, I think, is one that Michele will approve of. It's 4 active managers across styles. So we have a neutral or no style bias. We have a growth, a value, and an emerging market manager. Broadly diversified portfolios, fairly high tracking error individually, and initial weights, which look overly precise here, but they do have a purpose, and that's to ensure that there is no regional style bias within the analysis. So any alpha that we get out of this is pure stock picking, attributable to the manager. So the high tracking error of each individual manager, when we put them together, we get something like a 2.5% tracking error for the overall portfolio. And that's obviously the diversification benefits and the pitfalls that we've heard about today. And we've got fees on the active portfolio of 60 basis points. So this shows a test of our satellite portfolio at different levels of skill. So the skill level is really akin to a hit rate for an active manager. So a 50% hit rate means that there's no skill at all, that it's purely random. We've chosen and kind of aligned with our super funds beliefs that we can pick moderately skilled active managers. We've chosen skill level 56, which indicates that 56% of the manager stock picks are outperforming in a given year. You can see here we have a pre and a post-tax excess return line, and I guess the conclusion you can draw from this one is as your active risk increases, which is your higher level of skill, the tax drag on the portfolio gets higher. And I guess it's very intuitive at this stage, and this is what we're working with. So our particular satellite portfolio that we've chosen at skill level 56 generates pre-tax excess returns of around 1.1%, post-tax excess returns around 60 basis points at a tracking error of 2.4%. So you can already see here the impact the taxes are starting to have on the portfolio. We're giving up around 40 basis points in excess returns just because of tax. Which you go from having a fairly high achieving portfolio of around information ratio of about 0.5, which is pretty good in the long term, to we've roughly halved that. So your efficiencies have really been lost due to tax. And so with our core portfolio, which is our tax managed index, and our satellite portfolio, which is our skill level 56 combination, what does it look like when we combine the two? Here we have two efficient frontiers, one on a pre-tax basis and one on a post-tax basis, which shows every combination of the core and portfolio and the satellite portfolio from 0 to 100% either way. I want to start off at point B in the top right, which is a 20% allocation to the core, which means 80% active. And I think generally people who are focusing on pre-tax returns would think this is a pretty good outcome. You're generating 80 basis points of excess return. This is after fees for a tracking error of around 2%, or exactly 2% in this instance, which is a great outcome and one members would be happy with and one boards would be happy with. However, look what happens when we factor in tax and we drop from the solid line to the dotted line. We go from point B to point C, and you can see all of a sudden, for no reduction in risk, we have reduced our excess return, in this instance, by around 30 basis points, which is significant in the long term. So then if we move all the way over to the left, and point A is what our hypothetical fund has actually identified as its optimal portfolio. The reason for this is, whilst we have given up a very small amount in excess returns, we have a much higher degree of assurance over those excess returns, as we've seen the tracking error go from 2% down to around 75 basis points. And because of the flatness of the after-tax line, you can see why we can justify being so far across to the left. Okay, against my better judgment, I left this in, and it's pretty tough going later in the afternoon. But the idea of this is to really illustrate the different trade-offs that investment teams, investment committees and boards can go through when looking at creating an optimal portfolio and what's optimal for the particular fund. So just to briefly talk through this slide, down the left we have the combinations of core and active, and core and satellite, sorry, and across the top we have the different skill levels, and then we have each panel shows you something different about that particular portfolio. So the shaded line is what our fund can, the total shaded area is what our fund can invest in based on its constraints. So we had at the start 2% tracking error limits and a 50 basis point fee, which gives you some constraints of what we can do. And then we can start to see the total portfolios. I really won't spend too much time because it's better if you read it yourself. Other than to say that the bolded numbers are our particular portfolios, our particular fund's chosen portfolio. And then you can start to see what happens if you start to vary any of the variables. So you may have a higher conviction in active management, in which case you can move to the right. And in doing that, you can see, okay, my excess return is increasing, but so is the tax drag on my portfolio. So maybe if you want to be cognizant of tax, then that's something to know. You may have no conviction in active management and just say, okay, we want to be purely passive and have a very efficient portfolio, but we think you're probably giving up something by doing that. So we've chosen that particular portfolio. The paper goes into a lot more detail. I just want to leave it in there for now. And just to finish off, so portfolio construction involves a series of trade-offs that we've seen. We think it's really important for funds to start with a baseline in beliefs in order to create a portfolio that makes sense for them. We had our particular optimal portfolio, but everyone's going to have a different view. It will vary depending on your conviction in active management, your risk tolerance, how conscious you are of fees, and of course, how conscious you are of transaction costs and taxes. So we created our portfolio. We think it's a good structure from which to do it. And finally, like I said, I think most of you are over the line on this, which is encouraging. But I think the industry's got a long way to go on tax management and post-tax performance measurement. Tax does impact your net returns quite considerably at times, and so we think it's very important to factor that into your analysis. Thank you.
Thank you so much, Chris. Okay, ladies and gentlemen, I'm going to now open it up to the audience for any questions. So, as usual, you can use your app to send through questions, and if you have any that you'd like to ask in person, just pop your hand up and we'll get a microphone over to you as well. We've already got a question from the audience that came through while you guys were doing your presentation, so I want to start with that. Chris Bryant just asked, are there any observations from all of you on the risks that boards, consultants and investment staff may take by making factor decisions themselves versus leaving decisions to managers? How does that impact the optimisation of equity portfolios?
You want to start, or you want me to start?
Yeah.
Okay. It's a good question. I mean, that is one of the key challenges in terms of who takes that decision. Do you want to leave it up to your managers? And if you do that, then potentially, you may find that within the overall portfolio that you have more exposure to a particular factor that perhaps you feel less comfortable with. I think it's kind of a question of thinking through your overall portfolio, thinking about how it should be balanced, thinking about how you can generate the alpha that you want to generate at the right price. Because you find if you're paying a significant amount of fees away and not getting the right balance, then that's one of the key challenges, I guess, that you would face.
Raewyn, we haven't heard from you. I'd love to hear your thoughts on this.
Yeah, so I think factor investing is an interesting one, and in some ways I want to use the real world lens that Chris presented in our research, because I think most people who've looked at factor investing sort of see where it could sit in a portfolio and its merits. The issue in practice, it seems to me, is that if you're sitting in a fund and at the moment, you've got maybe a combination of passive and active. If your portfolio underperforms in relation to the passive component, well, that's the market, that's no one's fault. If your active satellites, any of those underperform, you can fire the manager or blame the asset consultant. So you can go forward in a practical way with those. As soon as you head down a factor road, it's something that brings in the spectre of career risk. So suddenly you're potentially putting your own neck on the line and saying, I want to do something different, and it becomes, at least in part, your decision, and there's no one to blame if the factor approach doesn't pay off. And there's certain factors that can, some very robust factors are expected to outperform over the long term, but there can be long periods sometimes where they underperform. And I think that it's a reason that a good idea doesn't go forward in practice because of the career risk issues around something like factor.
Chris, your and Raewyn's research looked at the impact of tax. So one of the questions we've got from the audience is, how can one improve the after-tax outcome from a passive portfolio?
Sure. So the approach that our fund's taken is a tax-managed indexing approach. I should hand over to Raewyn because it's what they do. Is that okay?
Raewyn, you can feel free. We've not heard from you, so you go ahead. Yeah.
So, well, I mean, the good thing about that question is that it allows me to point out that people that are seduced by this low turnover equals tax efficiency message are missing half of the story. So, while it's a good start to recognise that, all other things equal, fewer gains is a good thing from fewer realised gains, so fewer churn on portfolio with lots of gains is a good thing from a tax efficiency perspective. The other half of the story is that all other things equal, you want churn where there are losses in a portfolio. And, from time to time, I've had a look at a decomposition of any kind of sort of equity index, Australian or international, and even in a great year, there are stocks that you are holding at a loss or have held at a loss. And so there are certain styles of investing that create more churn on the loss side and less on the gain side. Because what you actually want from an after-tax perspective with passive management is you want to exploit an asymmetric preference in relation to turnover. Not turnover minimisation, but an asymmetric turnover in terms of gains versus losses. So sort of without going down a horribly technical road at this late stage in the afternoon, I think the really clever, truly sort of after-tax focused passive strategies do better than just minimise turnover. In fact, there's a research paper that I've released that sort of names about 10 differences between just a passive strategy and an actual after-tax focused passive strategy, and 10 things that are missing from just being passive.
Yep. Just to put it in context for many of the audience members who might not have picked up on this, but the research that Chris presented was, of course, a collaboration between the two of you. It's quite interesting. How did this collaboration between a manager and a major super fund come about? I mean, what are the benefits of having a collaborative approach like this? Because it's fairly unusual to see that.
Yeah, I think a lot of research that I see tends to be often quite academic and not implementable. And so when Raewyn pitched the idea, I thought it's a fantastic thing that Parametric's approaching it from a real practical perspective. And so my role in the research was really to add that practicality around the type of discussions that super funds have at the investment committee level, the type of constraints we deal with, and the types of issues we face.
Michele, you talked about the issue of over-diversification. What has led to over-diversification?
Well, it can be a lot of things. I mean, I think as Raewyn had pointed out, sometimes it can be a little bit about career risk. You don't want to put all your eggs into one basket, so you go and buy a whole bunch of baskets, which reduces the potential for you to, be blamed for underperformance by, having only one manager as opposed to multiple managers. Some of it can be fiduciary. For example, in the U.S., they're required to be diversified, but how much diversification is too much diversification? How much is enough diversification? These are the kinds of questions that there are really no answers to. And so I think what you get is just, an over-diversification just in order to kind of meet the fiduciary responsibility. So those would be some of the reasons. And perhaps just you've got, you might not want to let go one of your managers or a couple of your managers that might not be performing the way that you want them to, but you really want to generate those excess returns. So you just go out and hire another few managers that you think you're going to get that, and all of a sudden, before you know it, you've got quite a few managers.
We've actually got a question for you from the audience. It's actually to a comment you made. Someone has said, Michele's comment that everyone is interested in fees was, I assume, mostly tongue-in-cheek. How can we move the focus to net of fees and tax?
Net of fees and tax. It's a good question. I'm not sure that I have a great answer for it. Yeah, I mean, I think, you know, it's really a matter of kind of focusing on that combination of, you know, fees versus returns. You know, I guess when you're thinking about it from a portfolio standpoint, I mean, if you go back to just Sharp and how he thought about, you know, the overall market, is the active managers in the market ultimately were the market the same as the passive side of the market before fees, and after fees obviously it would be less. So I think, you know, I don't think that you can take the idea of fees out of things, because I mean ultimately, you know, that's you know, that's an area that's not going to go away. You obviously want to minimize your fees, but I mean, you know, when you're looking at things on an after fee basis, yeah, I mean that's the way that the market's going to look at it. But I mean, ultimately, what you're trying to do is minimize the impact on the returns that you're providing to your investors.
Raewyn, did you want to say something?
So can I answer that question by throwing back to one of the slides that Chris put up, which just graphed sort of excess return and tracking error, and had a pre-tax, and these are on net of fees, which is great, and then there was a curve which was pre-tax, and another curve, the dashed curve, that was post-tax. So, I mean, one start is that people that have great skills and are able to do that in their own portfolios are not just graphing that pre-tax line. They're actually doing something to have a look at the result or the expectations on a post-tax basis, and look at least two curves instead of one as a frontier of possibilities.
And Raewyn, to a point that you were talking about earlier, we've got a comment from the audience or a question, and he said, I think factors are no different to active managers, but do you think there's more tolerance for underperformance than traditional active managers?
In factor? Or?
Yeah, factors are no different to active managers. So do you think that there is more tolerance for underperformance than traditional active managers? Any one of you can answer, but I'll start with Raewyn.
So there's probably two parts of that. The first thing I'd say, I do think there's there is potentially a big difference between active managers and factor. In practice, there is a challenge to the industry now to identify active managers that are really factor huggers, right? And actually within that active management universe, make sure that you are getting active management and not factor management when you're hiring an active manager. So I think you can make that distinction and make sure that as much as you can, you're actually getting active managers that are targeting idiosyncratic risk rather than, you know, a simpler, cheaper, more transparent factor approach. I think it's hard to answer the second part of that question around the level of tolerance, because in practice, in Australia at least, I don't think there's much take-up on factors yet. So I don't think we've been able to test, and someone else might be able to correct me here, but I don't think we've been able to test the level of tolerance around an underperforming factor strategy yet in Australia.
Okay, we're quickly running out of time. I'm going to try and get through as many questions as possible. After-tax outcomes between accumulation and pension have different drivers. How do trustees structure a pooled fund to meet these different goals? Chris, do you want to take this one?
A single pooled fund? If that's the question, then it's very hard, because you do have completely competing tax levels. In a zero tax pension fund, you can churn the portfolio as often as you want, and you don't pay a cent in tax. In the pre-tax, in the accumulation phase, which is what the research was based on, then we showed that the post-tax and the pre-tax had a big impact on your returns. So my biggest advice is split your assets and manage two completely separate portfolios with different objectives and different tax rates.
This question's for you, Michele. As funds get larger in Australia, over-diversification will only increase. Is this one of the diseconomies of scale as super funds do get larger? And if so, what do you do about it?
Well, yeah, I mean, I think to some degree that's what we've been seeing in the US market as well. I mean, you're just getting larger and it becomes much more difficult to just hire one or two fundamental managers if that's the view that you want to take, simply because of scalability issues. But, you know, as I spoke about in my presentation, I mean, I think what you need to do is kind of think through holistically your overall portfolio, looking at, you know, what you can get at the cheapest price by utilizing, for example, things like enhanced in your core, giving you a little bit of alpha for a low tracking error, thinking about different ways of utilizing perhaps quantitative active managers, you know, which gives you that scalability. I know that there's certainly different views on kind of quantitative versus fundamental, and I think the real challenge, you know, as you get larger is if you have a real strong preference for fundamental, it does become extremely challenging, you know, just from a scalability issue. So I think it's thinking about incorporating some of the other things into your portfolio.
And does the research you talk about, you spoke specifically about equities, but is it relevant for other assets as well?
I mean,
asset classes?
If theoretically, from a mathematical standpoint, you know, it would certainly hold true, you know, in other markets. We haven't done the research on it, but, you know, for example, in something like fixed income, you could see the potential for it. However, I don't think we see it as necessarily being as over-diversified for a few reasons. One, you know, the indices are less efficient, so there's a lot more opportunity for active managers to generate alpha relative to the index. You also have, you know, it's not as uniform a market as the equity markets. You've got, you know, the muni markets, you've got, you know, high yield, you've got, you know, things like treasuries or mortgages, leverage loans. I mean, there's a lot of different areas that you can hire managers for, so there's not the same kind of uniformity. So it kind of lends itself perhaps to less risk of over-diversification. But what I would say, particular to Australia, I understand that there's a lot of interest in getting into the go-anywhere fixed income managers. And, you know, you get these guys that are going anywhere, and you think that you're not going to get a lot of overlap, but you might find out that they end up going in the same place. So if you have quite a number of managers, you could potentially have that risk of over-diversification.
Okay, I'm going to end on one last question from the audience, and this one is a comment for all three of you. Greg, thanks for the question. Warren Buffett suggests that the average person should go passive. In fact, he won a recent bet against active managers. Does the panel have any comment? No comment. There you go.
Interesting. Our CIO in Seattle did a blog on that where he said, "Look, it's even worse for active managers on an after-tax basis." So you know, that's not surprising. So you know, the way I think about it is that, you know, there's actually sort of 4 options now instead of 2, and that's even before we think about factor and smart beta. So if there's active and passive, there's the opportunity to also think about whether you're active or passive in relation to the tax management piece. So what I would like to see going forward is that Warren Buffett or whoever it is, isn't just doing this comparison on a pre-tax basis between active and passive, but is also saying, you know, what's the full suite of options, including active with active tax management? You know, what does that bring in a clever solution like centralised portfolio management or something? How does that sort of bring active managers collectively back into the mix versus passive and then passive, and then all of the different options? So we can now probably do a lot more options in the way that we compare that challenge.
Great.
I think the problem is not necessarily with the active managers underperforming. I think it's with investor behaviour. And you know, in general, investors are unable to continue to back an underperforming manager. And so they tend to sack them at the bottom of their performance cycle, hire somebody who's outperforming, and so the negative alpha compounds. yeah, I'd say it's more about investor behaviour and having a framework internally to back something that's not working in the short term.
Last words?
Well, I just think, coming from a fixed income background, I think active, there are opportunities probably because there's more inefficiencies. The challenge comes certainly on the equity side where there's a lot fewer inefficiencies in that respect. But I think that there are always circumstances in the markets where there are inefficiencies through either market movements, through different players in the markets. The markets are always changing, so that does lend itself to potential opportunities. So I think there is a role for active.
All right, lovely. Thank you so much, all three of you, for your time today. Please put your hands together for them.